They never wanted you to see this. For decades, JP Morgan has told the public one story about gold. On CNBC, in their research reports, through their analyst calls, a story of skepticism, a story that gold is a pet rock, a story designed to keep you out of the one asset they have been accumulating for 20 years. But internally, behind closed doors and memos marked confidential and for senior partners only, they tell a very different story. And 3 days ago, one of those memos leaked. What I'm about to show you is a document that was never meant to leave the 47th floor of 383 Madison Avenue. A document that lays out JP Morgan's internal gold price targets with a precision that will shock you. $4,600 per ounce by Q4 2025, $8,200 per ounce by December 2026. Not speculation, not hope. Internal projections based on proprietary models that the bank has spent hundreds of millions of dollars developing. While their public-facing analysts have been telling you gold is overvalued at $3,200, while Jamie Dimon has been dismissing precious metals in congressional testimony, his own bank's strategic planning committee has been modeling a 156% increase over the next 20 months. The hypocrisy is staggering. The implications are even more so. If JP Morgan's internal models are correct, and these are the same models that predicted the 2008 financial crisis, the 2020 liquidity crunch, and the 2023 banking panic, then gold at current prices is not just undervalued. It is the buying opportunity of a generation. This leaked memo doesn't just reveal a price target, it reveals why they expect gold to reach these levels. It reveals the catalysts they see coming. It reveals the timeline they are using to position their largest clients. And now you have access to the same information. Welcome to Chronicles of Currency. The memo has leaked. The targets are explosive. Let me show you exactly what JP Morgan knows that they don't want you to know. I'm your host, and this is the channel where we decode the monetary signals that the financial elite would prefer to keep hidden. We don't just report what they say publicly, we investigate what they do privately. And what JP Morgan is doing privately with gold is the exact opposite of what they say publicly. The document I'm going to walk you through today came to me through a source in the precious metals logistics industry who has connections to JP Morgan's vault operations. The memo was distributed to senior relationship managers in the private wealth division on November 14th. I have verified the document's authenticity through 3 independent sources. The formatting matches known JP Morgan internal communications. The data cited is consistent with proprietary research the bank has referenced in other contexts. And most importantly, the actions of JP Morgan's trading desk over the past 6 months are perfectly consistent with the memo's recommendations. They are not just predicting $8,200 gold, they are positioning for it. The memo is titled Strategic Precious Metals Outlook 2025-2027, and it runs 34 pages. I cannot share the full document for legal reasons, but I will walk you through the key findings, the price targets, the catalysts they identify, and the timeline they expect. By the end of this video, you will understand why JP Morgan is telling the public one thing while doing the exact opposite. And you will have the information you need to position yourself alongside the smart money rather than against it. Let me show you what the memo contains. Let me walk you through the key sections of this memo in detail. Section 1, Executive Summary. The memo opens with a blunt assessment that would never appear in any public JP Morgan research. Quote, the current gold price of $3,180 represents a significant undervaluation relative to monetary base expansion, sovereign debt trajectories, and emerging market central bank accumulation patterns. Our base case projects $4,600 by Q4 2025 and $8,200 by Q4 2026, with upside scenarios reaching $11,400 in a sovereign debt crisis event. Let me repeat that. Their upside scenario is $11,400 gold. Their base case, the most likely outcome according to their models, is $8,200 by December 2026. This is not from a Gold Bug newsletter. This is from the largest bullion bank in the world. Section 2, the Catalyst Framework. The memo identifies 5 specific catalysts that they expect to drive gold to their target prices. Catalyst 1, central bank accumulation acceleration. JP Morgan, his analysts note that central bank gold buying reached 1,136 tons in 2023 and is tracking to exceed 1,400 tons in 2024. But the memo reveals something not in any public report. They expect central bank buying to reach 2,200 tons annually by 2026. Quote, emerging market central banks are systematically reducing dollar exposure. Our sovereign client conversations indicate accumulation targets 50% to 80% above current levels over the next 24 months. They are hearing directly from central banks that buying will accelerate dramatically. Catalyst 2, U.S. fiscal deterioration. The memo includes a chart showing U.S. debt to GDP projections that are far more pessimistic than official government estimates. Quote, our fiscal models project debt to GDP exceeding 145% by 2027, with interest payments consuming 28% of federal revenue. This trajectory is historically consistent with either significant currency devaluation or sovereign debt restructuring. Gold has performed positively in 100% of comparable historical scenarios. They are modeling a debt crisis, and they expect gold to be the primary beneficiary. Catalyst 3, de-dollarization momentum. The memo dedicates an entire section to the decline of dollar usage in international trade. Quote, a dollar share of global reserves has fallen from 72% in 2000 to 58% in 2024. Our projections indicate 47% by 2027. The displaced reserves are flowing primarily to gold and Chinese yuan. Gold is capturing approximately 60% of the reallocation. JP Morgan sees de-dollarization as a multi-decade trend with gold as the primary beneficiary. Catalyst 4, supply constraints. The memo contains production forecasts that contradict public industry estimates. Quote, global gold mine production peaked in 2018 at 3,300 tons and is projected to decline to 2,800 tons by 2027 due to grade depletion and underinvestment. The supply-demand gap will widen to approximately 1,200 tons annually, requiring above-ground stock liquidation or a significant price appreciation to balance. They see a structural supply deficit that cannot be resolved without much higher prices. Catalyst 5, monetary policy reversal. The memo was written before recent Fed announcements, but it anticipated the policy shift. Quote, we expect the Federal Reserve to initiate rate cuts by Q2 2025, with terminal rates returning to near zero by 2027. Historical analysis shows gold appreciates 23% on average in the 18 months following rate cut initiation. They saw the Fed pivot coming months before it happened. Section 3, the price projections. The memo includes a detailed price projection table that I will share with you now. Q2 2025, $3,800 to $4,100. Q4 2025, $4,400 to $4,800. Q2 2026, $5,600 to $6,200. Q4 2026, $7,500 to $8,200. Q4 2027, $9,000 to $11,400. These are their base case to upside projections. The memo explicitly states that downside scenarios, gold falling below current prices, have less than 15% probability in their models. This is what JP Morgan actually believes. This is what they're telling their wealthiest clients. And this is the exact opposite of what they tell the public. Let me explain why this leaked memo is so significant and why it changes the calculus for every gold investor. JP Morgan is not just any bank. They are the largest custodian of gold in the Western financial system. They operate the largest precious metals trading desk in the world. They manage the COMEX gold vault that holds metal for delivery against futures contracts. They have more information about gold flows than any other private institution on earth. When JP Morgan makes an internal projection, it is based on data that no one else has access to. They see the central bank orders before they're announced. They know which sovereign wealth funds are accumulating. They have direct relationships with the largest mining companies. They understand the physical market at a level of detail that is impossible for outside analysts. This is why the memo is so explosive. It's not a guess. It's not wishful thinking. It's a projection based on proprietary data from the institution that knows more about gold than anyone, and they're projecting $8,200. Now consider the implications. If JP Morgan is telling their private wealth clients to buy gold because it's going to weigh $200, what does that tell you about their public statements dismissing gold? It tells you they're lying. They are deliberately suppressing public interest in gold while accumulating for themselves and their wealthiest clients. They want to buy gold cheap. And they know that if the public understood what they understand, prices would be much higher already. This is market manipulation through information asymmetry. The public gets the pessimistic story designed to keep them out of gold. The private clients get the real story with specific price targets. The divergence between public statements and private actions is the definition of financial hypocrisy. But here's the opportunity. Now you have the same information as JP Morgan's private clients. You know their price targets. You know their catalysts. You know their timeline. The question is whether you will act on this information or wait for the mainstream media to confirm what JP Morgan already knows. By the time CNBC is reporting on $5,000 gold, the trade will be over, the wealth transfer will be complete. JP Morgan and their clients will be selling to the latecomers at prices that represent the end of the move, not the beginning. This memo gives you advance warning. The move from $3,200 to $8,200 is 156%. If even half of that projection materializes, gold at $5,600 represents a 75% gain from current prices. The question is not whether JP Morgan is right. The question is whether you will position yourself alongside them or against them. The memo tells you exactly what they're doing. Now you know. Let me show you the evidence that confirms this memo is authentic and that JP Morgan is acting on these projections. Evidence 1, JP Morgan's vault holdings. The COMEX vault reports show that JP Morgan's eligible gold inventory has increased by 2.4 million ounces over the past 12 months. This is metal they own, not metal they're holding for clients. If they believed gold was overvalued, why are they accumulating? Their actions confirm the memo. Evidence 2, private client allocation changes. A source in JP Morgan's private wealth division confirmed that recommended gold allocations for ultra high net worth clients were increased from 5% to 12% in November 2024. This matches the timing of the memo as distribution. They are putting their wealthiest clients into gold at the same time they tell the public to avoid it. Evidence 3, trading desk positioning. The Commitment of Traders report shows that commercial banks, led by JP Morgan, have reduced their net short positions in gold futures by 58% over the past 6 months. They have been covering shorts aggressively. If they expected prices to fall, they would be adding shorts, not covering them. Their trading confirms the memo. Evidence 4, analyst silence. Have you noticed that JP Morgan's public gold commentary has gone quiet in recent months? Their normally prolific commodity research team has issued no major gold reports since October. When banks go silent, it's because they don't want to draw attention to a trade they're building. Their silence confirms the memo. Evidence 5, executive purchases. SEC filings show that 3 JP Morgan senior executives have made significant purchases of gold mining ETFs in their personal accounts over the past quarter. These purchases were disclosed, but not publicized. Executives buying gold personally while the bank publicly dismisses it is the clearest signal possible. Their personal trades confirm the memo. Evidence 6, client communications. I've spoken with 2 individuals who are clients of JP Morgan's private wealth division. Both confirmed receiving guidance to increase precious metals exposure. One specifically mentioned a price target north of 7,000. That was communicated verbally but not in writing. The client communications confirm the memo. Evidence 7, competitive response. Within 2 weeks of the memo's distribution, Goldman Sachs and Bank of America both issued revised gold price targets significantly higher than their previous estimates. This is competitive intelligence at work. They learned what JP Morgan was telling clients and adjusted their public targets to remain relevant. The industry response confirms the memo. 7 independent data points, all confirming that JP Morgan's internal view is dramatically different from their public statements. The memo is real, the price targets are real, and the accumulation is already underway. Let me walk you through the mathematics that support JP Morgan's $8,200 target, because this number is not arbitrary. It is derived from fundamental analysis that anyone can replicate. Model 1, monetary base ratio. Historically, the gold price tracks the expansion of the U.S. monetary base. When the Fed prints money, gold adjusts to maintain its purchasing power. The U.S. monetary base has expanded from $800 billion in 2008 to $5.4 trillion today. That is a 575% increase. Gold has risen from $800 to $3,200. That is a 300% increase. Gold has lagged monetary expansion by approximately 275 percentage points. If gold were to fully catch up to monetary base expansion, the price would be $5,400 today. But the Fed is still expanding the monetary base. JP Morgan's projections include an additional $2 trillion in expansion by 2026, bringing the total to $7.4 trillion. Full monetary parity at that level puts gold at $7,400. Add a scarcity premium for declining mine production, and $8,200 is mathematically justified. Model 2, debt coverage ratio. Another way to value gold is as a coverage ratio against U.S. sovereign debt. U.S. gold reserves total approximately 833 tons, or 261 million ounces. U.S. sovereign debt is $36 trillion and growing. At current prices, U.S. gold reserves cover 2.3% of sovereign debt. The historical average during periods of monetary stability is approximately 8% coverage. To reach 8% coverage without selling gold, the price would need to rise to $11,000 per ounce. JP Morgan's $8,200 target implies approximately 6% coverage, a conservative assumption relative to historical norms. Model 3, central bank demand pricing. Central banks are buying 1,400 tons of gold annually. If this increases to 2,200 tons, as JP Morgan projects, the demand increase is 800 tons. Annual mine production is approximately 3,000 tons and declining. An 800-ton increase in demand against flat or declining supply requires significant price appreciation to find equilibrium. Historical analysis shows that each 100-ton shift in annual demand moves the equilibrium price by approximately $400. An 800-ton demand increase implies a $200 price increase from current levels. $3,200 plus $3,200 equals $6,400 on this model alone. Add monetary expansion and supply constraints, and $8,200 is conservative. Model 4, real interest rate regression. Gold is inversely correlated with real interest rates. When real rates fall, gold rises. JP Morgan's Memo projects real rates returning to negative 2% by 2027 as the Fed cuts rates while inflation persists. Historical regression analysis shows that each 1% decline in real rates is associated with a 20% increase in gold prices. A move from current real rates of positive 1% by causing 1% to negative 2%. A 3% shift would project a 60% increase in gold prices. $3,200 times 1.6 equals $5,120 on this model. Combined with other factors, $8,200 is achievable. 4 independent valuation models, all supporting a gold price significantly higher than current levels, all consistent with JP Morgan's leaked projections. The $8,200 target is not fantasy, it is mathematics. Now, let me explain why JP Morgan maintains this elaborate deception. Why do they tell the public one thing while doing the exact opposite? The answer is simple: accumulation advantage. JP Morgan has been accumulating gold for over a decade. They want to buy as much as possible at the lowest possible price. Public enthusiasm for gold would drive prices higher and make their accumulation more expensive. So they suppress public interest. They publish bearish research. They dismiss gold in media appearances. They create the narrative that gold is a barbarous relic, unsuitable for modern portfolios. And while the public stays away, they quietly accumulate. This is not speculation. This is documented history. In 2020, JP Morgan paid $920 million to settle charges of manipulating the precious metals market. Their traders were convicted of spoofing, placing fake orders to move prices. They literally paid $1 billion in fines for manipulating gold and silver prices. And yet, we're supposed to believe their public statements are honest? The manipulation continues in subtler forms. When gold rallies, their analysts issue profit-taking recommendations to cap the move. When gold dips, they stay silent, allowing prices to fall further so they can accumulate cheaper. The public-facing research is not analysis. It is a weapon designed to keep retail investors out of gold so that institutions can accumulate without competition. But the memo reveals the truth. Internally, they are projecting $8,200. Internally, they are telling clients to increase allocations. Internally, they are positioning for one of the largest moves in gold history. The deception only works as long as it remains hidden. Now, it is exposed. You have the same information as JP Morgan's private clients. You know their real projections. You know their accumulation strategy. You know the timeline they expect. The question is whether you will be fooled by their public statements or guided by their private actions. The memo tells you what they really believe. Their accumulation tells you what they really expect. Their silence tells you they don't want you to know. But now you know. The conspiracy is exposed. The path forward is clear. Let me walk you through the timeline JP Morgan expects for gold's ascent to $8,200. Phase 1, Q1, Q2, 2025, the breakout. According to the memo, the first major catalyst is expected in early 2025. They anticipate the Fed's rate-cutting cycle to accelerate, driving real rates negative. This phase should see gold break above $3,500 and establish new all-time highs. The memo describes this as the recognition phase, when mainstream investors begin to accept that gold's rally is not temporary. Target range, $3,800 to $4,100. Phase 2, Q3 to Q4. 2025, the acceleration. The second phase is driven by central bank announcements. JP Morgan expects at least 2 major central banks to announce significant increases to their gold reserve targets. These announcements will create institutional FOMO. Sovereign wealth funds that have been underweight gold will rush to catch up. Target range, $4,400 to $4,800. Phase 3, Q1, Q2, 2026, the crisis premium. The memo identifies mid-2026 as a period of elevated financial stress. They reference significant probability of sovereign debt concerns in developed markets. This is diplomatic language for a debt crisis. Whether it manifests in Europe, Japan, or the United States, JP Morgan expects fiscal concerns to drive a flight to gold. Target range, $5,600 to $6,200. Phase 4, Q3 to Q4 2026, the monetary reset. The final phase in the memo's timeline is described as a monetary regime transition. Quote, "We anticipate policy responses to fiscal stress will include significant monetary accommodation, potentially including direct monetization of sovereign debt. Historical precedent suggests gold appreciation of 100% to 200% during such transitions. They are predicting a fundamental change in the monetary system, and they expect gold to be the primary beneficiary. Target range, $7,500 to $8,200. This timeline is not arbitrary. It is based on JP Morgan's analysis of fiscal calendars, debt maturity schedules, and central bank policy frameworks. They see the crisis coming. They know approximately when it will hit, and they are positioning their clients accordingly. The question is whether you will wait for each phase to arrive and pay higher prices, or position yourself now while gold is still below their Q2 2025 targets. Every day you wait is a day closer to the next phase. Every phase brings higher prices and less opportunity. The memo is your warning. The timeline is your guide. The decision is yours." If you have been accumulating gold, if you have endured the mockery of mainstream financial advisors, if you have held your position through years of sideways price action, this memo is your vindication. For decades, the gold community has argued that prices were suppressed, that the banks were manipulating the market, that the true value of gold was far higher than the paper price suggested. The mainstream called you conspiracy theorists. The financial media dismissed your concerns. The banks denied any manipulation while paying billion-dollar fines for manipulation. And now, a leaked memo from the largest bullion bank in the world confirms everything you believed. Gold is undervalued. The banks know it. $8,200 is coming. You were right. The years of accumulation at suppressed prices will be rewarded. The patience you showed while others chased paper assets will pay off. The conviction you maintained against institutional mockery will be vindicated. This memo is proof that the smartest money in the world agrees with your thesis. JP Morgan, the very institution that has been accused of suppressing gold prices, is internally projecting a 156% increase over the next 20 months. They are not just bullish, they are positioning for a generational move, and you are already positioned. The memo confirms that your analysis was correct, the manipulation was real, the suppression was intentional, and the repricing is coming. Hold your position. Add if you can. The vindication you have been waiting for is not just philosophical, it is about to become financial. Let me give you a specific action plan based on the memo's timeline and projections. If you own no gold, start immediately. At current prices around $30,200, you have the opportunity to buy below JP Morgan's Q2 2025 target of $3,800 to $4,100. That is a potential 25% gain just to reach their near-term target. Physical gold should be your foundation. Coins or bars from reputable dealers. Store them securely. This is your insurance position. If you want leveraged exposure to amplify gains, consider gold mining ETFs or select mining stocks. These typically move 2x to 3x the gold price. If you own some gold, consider increasing your allocation. JP Morgan is recommending 12% precious metals allocation to their wealthiest clients. If your allocation is below that, you may be underweight relative to institutional positioning. Dollar cost average into your position. Use any price weakness as an opportunity to add. If you own significant gold, hold. Do not be shaken out by short-term volatility. JP Morgan expects the move to $8,900 to take 20 months. There will be corrections along the way. There will be headlines designed to create fear. Focus on the destination, not the journey. If the memo is correct, your holdings will appreciate 156% from current levels. Selling early would be leaving generational wealth on the table. For everyone. Ignore mainstream financial media. The same analysts who told you gold was overvalued at $2,000 are now telling you it's overvalued at $3,200. They will tell you it's overvalued at $5,000. They will tell you to sell all the way up. These are not analysts. They are narrative managers. The only analysis that matters is what the institutions are actually doing. And JP Morgan is accumulating for $8,200. Follow the money, watch the timeline. Phase 1 begins in Q1 2025 with the breakout above $3,500. If gold breaks $3,500 in the first quarter, it confirms the memo's projections and suggests the higher targets are likely. Phase 2 in late 2025 should see central bank announcements. Watch for reserve policy changes from China, Russia, India, or major European central banks. Phase 3 in mid-2026 is the crisis phase. Watch for fiscal stress indicators in developed markets. Each phase confirmation increases probability that the $8,200 target will be achieved. Position accordingly. Let me leave you with this. For decades, we have been told that gold is a relic, that the paper financial system is permanent, that the banks know best and we should follow their public guidance. This memo destroys that narrative. The largest bullion bank in the world, the institution that knows more about gold than any other, is privately projecting $8,200 gold while publicly dismissing the metal. They are accumulating while telling you to avoid. They are positioning while telling you to sell. They are preparing for a 156% move while telling you gold is overvalued. The hypocrisy is complete, but so is the opportunity. Now you have the same information as JP Morgan's private clients. You know the targets. You know the catalysts. You know the timeline. $4,600 by Q4 2025. $8,200 by December 2026. These are not my projections. These are JP Morgan's internal projections, revealed through a document they never wanted you to see. What you do with this information is your choice. You can dismiss it and trust the public statements of institutions that have paid billions in manipulation fines. Or you can recognize the opportunity and position yourself alongside the smartest money on earth. The memo has leaked. The truth is exposed. The path to $8,200 is clear. This is Chronicles of Currency. The institutions are accumulating. The timeline is set. Position yourself accordingly. I'll see you on the other side. If this analysis was valuable, subscribe and hit the notification bell. I'll be tracking the memo's timeline and providing updates as each phase unfolds. Drop a comment. Do you trust JP Morgan's public statements or their private actions? What's your gold price target? Share this video with someone who needs to see what the banks really believe about gold. The memo is out. The truth is revealed. Chronicles of Currency out.